Hi, welcome to Dorchester Advisors. Today, I want to talk about the investment portfolio we use with our clients. I think you'll find this useful information and give you some good insights. In case we haven't met before, my name is Dushyant and I'm the founder and managing director of Dorchester Advisors. Here, we work with our clients to help them build solid retirement portfolios that are capable of providing them with enough income to sustain their lifestyle throughout their retirement. Now, let's talk about our investment objective. Our investment objective is to double clients' assets over a 10-year period. And in this video, I want to give you a clear look at how we build and manage portfolios so you understand exactly what's going on behind the scenes. Our portfolios hold about 12,000 stocks and about 500 bonds. This is an extraordinary level of diversification. But when you look at your account statement, you'll usually see just a few holdings, a handful of ETFs. That's because ETFs are basically packaging vehicles. Inside them are thousands of individual securities. Now, what really matters is not the wrapper, not the ETF, but the underlying companies and bonds inside the ETF. That is what drives performance. So think of an ETF like a suitcase. The suitcase itself isn't important. What's packed inside it is what matters. And in our case, each ETF carries hundreds or even thousands of securities, giving you exposure to companies across the globe. Now let's unpack our portfolio along three key dimensions: size, sector, and geography. Our portfolio holds companies of all sizes, from small to large. Why? Large companies are like oak trees, stable, well-rooted, and rewarding to shareholders. Small companies, by contrast, are like acorns. While many may remain small and profitable, many turn up to grow into tomorrow's oaks. For example, Microsoft, Apple, Nvidia all started out as small firms decades ago, but have grown into mighty acorns. So by holding companies of every size, large, mid, and small, your portfolio captures both stability and growth potential. So our current portfolio is about 67% in large companies, about 22% in mid-sized companies, and about 10% in small companies. A nice array of stability and growth potential. Now, good diversification also means investing across many industries: technology, healthcare, finance, consumer goods, utilities, etc. This exposure ensures that you participate in the full economy, not just a small slice of it. So our current portfolio is invested in all 11 sectors. And the three largest sectors, for example, are technology, about 26%, financials, about 14%, and real estate through REITs, about 11%. Finally, we also diversify across countries. Only owning US companies would mean missing out on global players like Toyota or BMW, Nestle, Shell, etc. It would also mean missing out on the growth of emerging markets, countries like India, countries like China, etc. So international exposure helps to balance risk and broaden opportunities for an American investor. So our current portfolio is diversified across the globe, with about 79% in US companies and about 17% overseas. Again, we think this gives a sensible diversification. So put together, this diversification by size, by sector, by geography creates a resilient portfolio. Now, diversified portfolios such as ours rarely sit at the very top of their performance rankings, but they also avoid the painful lows of concentrated bets. And as the saying goes, you concentrate to create wealth, but you diversify to protect it. And most of our clients are in the wealth protection stage of life, so diversification is the smarter approach for them. Now, no discussion of a portfolio would be complete without considering its costs and tax impact, etc. So our portfolios are very competitive in the industry when it comes to costs, yields, and taxes. And this is based on a survey by BlackRock of about 8,500 advisors. Let's talk about costs. By using ETFs that are carefully selected, we keep expenses amongst the lowest in the industry, often in the cheapest percentile of all the advisors. For example, our portfolio cost is about 5 basis points, 0.05%. Yet, our main holdings consistently rate 4 or 5 stars in Morningstar, which is the preeminent provider of investment data. So, it means you're getting both value and quality to our clients. Yields. Our portfolio yield is significantly better than the median yield of the 8,500 advisors. And currently, it has a 12-month yield of about 1.75%. Finally, taxes. Again, comparing to the other 8,500 advisors, we estimate the tax impact of this portfolio is below median level, which means the tax rate is below median level. So, what comprises this portfolio? Examples of the top holdings are companies like Microsoft, Nvidia, Amazon, Broadcom, Berkshire Hathaway, etc. Now, ultimately, our aim is to grow your wealth prudently. While nothing is guaranteed, our target and objective is to try to double your money every 10 years without taking unnecessary risks and without high costs eroding returns. That is the essence of Dorchester Advisors' investment approach: to be prudent, to be sensible, and to be cost conscious. Again, thanks for listening in. I invite you to look through our website, and if our philosophy and approach resonate with you, give me a call. No obligations. I love talking all things investing. Thank you.